In this episode, I answer the question, can all of my expenses be paid through my infinite banking policies? And I also dive into what Nelson Nash, the creator of the infinite banking concept, meant when he said in his book that premiums and income should match. I'm Nate. I make sense out of money. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered. All right, everybody, welcome back to the show. It's great to have you again. And as I've been saying lately, we love that you're here. I love doing this show. I love talking about all things infinite banking. And we are trying to grow the reach of our channel and our show. So if you have been a long-time listener and have enjoyed these podcasts or getting value from them, if you would like or subscribe or review or rate wherever it is that you consume it, it would mean the world to us. And in this episode, I'm going to dive into a question that almost everyone has at some point whenever they get into the infinite banking concept, especially whenever they get deep into the infinite banking concept. And that's like, well, Nate, if I can put money into policies and pay for bigger expenses, can this also work for the little expenses of my life? Like, can I pay for my utilities and my mortgage payments and, my grocery bill? Can everything go through these policies whenever I build out this becoming your own banker system? First off, I want to say congratulations. I love this. I love the fact that you are thinking on those lines. I love the fact that you want to take infinite banking to its greatest extent. But, and here is the but, it is far more difficult and less exciting to get to that level than maybe you think it is. In other words, what I find concerning is when people who are just starting out with infinite banking start asking me questions like, well, I'm going to go on vacation. We got grocery bills, we got utilities. Can I just run all of that through my policy? And maybe they have one policy, they just got started recently, and they're trying to think on those lines. That's exciting. I love it. However, there's just absolutely no way that it makes sense to do those types of things right away. And there's reasons for it. And so Nelson Nash really started this. He started the whole concept, but he started this idea that everything should run through policies. When he said in his book, that's pretty famous in the infinite banking cult, of which I'm a part of, where he said premiums and income should match. And he describes in his book that doesn't all of your income go into banks already, and then you use your bank accounts to pay for everything in life? If you owned your own bank, wouldn't you want that same, financial energy to flow through your banking system, not somebody else's, to go fund the things of life? And so I firmly believe in the philosophy and the idea that he's trying to present. I would say that in practical means, it becomes very difficult to actually achieve this. And I wanted to kind of cut it, nip it at the bud, where there's nothing magic about IBC. You can't just borrow money from a policy to pay for your groceries and then pay that money back in and suddenly be making more money than you would have made. It's not a magical process. And this is what I think can confuse people whenever they get into it. And so going from that vein, there are solutions available now that you can kind of do this. And I want to present this idea. Or can my expenses be paid through my infinite banking policies? How does that work? What does Nelson Nash mean when he says all of my income should be going into premiums? What does he mean by this? So I'm going to tackle both of those. I'm going to start with, can all of my expenses be paid through the policies? And I would say that until recently, in the last 5 years or so, it was actually very difficult to do this because insurance companies, first off, don't like it whenever you are sending multiple transactions to back and forth, churning money inside of policies. So in other words, you're paying a premium and then you're immediately taking a loan out to go pay for groceries, and then you get your paycheck and then you immediately send money back and then you borrow another loan, and you're doing all sorts of transactions. They're not set up to handle those types of things. So while you have every right as a policy holder to do those things, the insurance companies will give someone like me a call. They'll give your advisor, your agent a call, and they'll be like, what do you got going on there? You're overwhelming our service department. We can't handle this type of flow. And secondly, it's actually just difficult to do. In other words, you've got to, it's not like overnight bank transfers typically occurring. So you've got to request a policy loan. It takes, 3 to 5 business days, and then it hits your account, and then you do some things, and then you send money back, and it takes a few days for them to process, and then a few days to get it back. It's not a practical thing to do it that way. But with the advent of what's known in the circle as life insurance line of credit or cash value line of credit, essentially where I'm going at with this is that banks have decided that they will come in and provide a solution to people who own whole life insurance policies that doesn't exist inside of the actual insurance companies themselves. And so what that means is banks have come in and said, you know what, we can offer banking style situations to where people can use their policies in a more banking format than in a policy format. So they say, we will offer, if you own a policy, you can actually open up a line of credit with us and treat it just like any other line of credit. And most of them will have like 95%, maybe even 99% of your cash value. They will offer you a line of credit to with no very, very streamlined application process to open this line of credit. And so it's tied to the policy, and that line of credit operates very similarly to a policy loan. So what that kind of means is like, just like whenever you take a policy loan against your cash value, you're using your cash value as collateral to receive a policy loan from the insurance company. And all of your cash value remains intact and growing and earning interest and dividends the whole time, and you pay the loan back on your own terms. And that same type of flow is actually offered by these banks who are kind of stepping in and filling a need, right? And so they say, we'll offer a line of credit up against using your cash value as collateral, just like the insurance companies will allow you to do. And we'll do almost all of it, 95 to 99% of it. We'll offer you a line of credit to utilize against your cash value. And so, but here's where I'm going at with this. I'm not in this episode diving into all the details of the life insurance line of credit, nor am I even recommending that you open it. The only reason I'm bringing this up is because if you want to, the life insurance line of credit option that a bank will come in and say, we'll offer you a loan against your cash value, opens up an opportunity to where you could envision and accomplish this idea of all of your expenses and all of your income can flow in and out of policies without, some impracticality. In other words, while it's actually a practical thing. So essentially, you can open up the life insurance line of credit, and it's kind of attached to your policy. It's using your cash value as collateral. You can borrow against as much as you want. The repayment is very, very similar to a policy loan. In other words, it's interest only for a long period of time and then can be kind of reset once the time period ends. But what I'm trying to bring up is you can add a flair of where because the line of credit has an account number and a routing number, you could essentially use it like a bank account. It operates just like a bank account. And if you have been familiar with a term that exists called velocity banking out in the world, I'm not a huge proponent of velocity banking, but the idea is essentially you can open up like a home equity line of credit. You can open up some form of line of credit where you just operate using that line of credit as your new bank account. It's got an account number, it's got a routing number, you can do bill pay from it, you can do online transfer of money, all you want. And so you could essentially create a world in which you have your life insurance line of credit attached to your policies, and you are paying all your bills from the life insurance line of credit, and all of your income is flowing into that pool. And you can do it in a practical way where you're not dealing with the insurance company where you're waiting 5 business days and sending money back in and no online banking opportunity. You can get online banking with a checkbook, with a routing number and account number, with bill pay opportunities. And so you could create a way in which you can kind of run all of your expenses through that just using policies can be very, very, very difficult to accomplish this. And so you add this velocity banking flair to infinite banking. So you add this velocity banking flair where all of your money goes against the line of credit, and all of your expenses and investments are paid from the line of credit. That is a possibility, but what I'm trying to bring up is there's nothing magical even about that. It can make sense, but there's nothing exactly magical about doing that. The whole goal of doing it that way is just to try to earn and maximize the amount of interest that can be earned on every single dollar. The idea is simply you don't have any idle money. Like you don't even really have any money in a bank account. You have all of your money in cash values, and you're having all of your money flow into policies where it's going to be growing and earning. But the idea, what I'm trying to bring up is that if you do the model that doesn't require that I've already been teaching lately, which is you just keep a very small amount of money in checking accounts anyway, and you keep all of your money in policies to begin with, then the only thing you haven't done in that model is the tiny bit of money that would be earned each month on your expense account. The tiny little bit of money that you would earn inside of your expense account, you could earn if you started running everything through the policies and opened up the life insurance line of credit and just treated it like a checking account. You could maybe earn a little bit more, but what I'm saying is it's marginal. The big picture is what you need, to accomplish, which is essentially you need to commit to the policies being your capital warehouse, where all of your capital goes into policies first before it's deployed to do the various things of life. And if you've been listening, you would know that what I'm trying to say is all of your money goes into policies, and all of the bigger capital-driven expenses are paid from policies or investments, larger ticket items, home remodels, even your tax bills, your vacation could even go through. But typically the bigger items are what we would focus on with policies. So the only money that doesn't enter policies would just be your monthly expense money. And what I'm trying to say is you can include that, especially with the life insurance line of credit model. You can start doing that, but the amount of money you'd make above and beyond the fact that all of your capital is in policies is actually very small. It's not a huge increase in profits just by doing the velocity banking style where all of your income goes into the policies and all of your expenses are paid from the life insurance line of credit. That might offer a little bit, but don't let the nickel hide the dime. Like, don't get so focused on that small piece of your budget, which is your lifestyle expenses, because all you're talking about is the short amount of time that it would be in the policy until the next bills are paid, and it's very, very small amount of interest.
Are you tired of feeling like everyone has their hand in your pocket? At Living Wealth, we believe in challenging the status quo. After all, most of those conventional tools only seem to make someone else rich. Let us show you how to take back control by banking on yourself. Visit livingwealth.com/escape-the-bank. You'll receive instant access to what we call the beginner's course. This free, in-depth, easy-to-follow course teaches people how to create and profit from infinite banking. We not only discuss the philosophy and principles behind infinite banking, but also offer real-life examples to demonstrate how it works. Even folks experienced with infinite banking often tell us they learned a ton too. So, it's worthwhile regardless of your experience level. Stop letting banks and Wall Street dictate your financial future. Again, that's livingwealth.com/escape-the-bank to gain access to the free course today. Now back to Nate and Holly.
So to answer the question, can all of my expenses, grocery bills, everything be paid from policies? It's very impractical to do it, just dealing directly with policies to and from, like from the insurance company. It can be done easier now with the advent of these life insurance lines of credit from banks, but it's not for everybody, and it's got to be the last thing you do. Like, if you can't start doing that, there's no sense in doing that until all of your capital has been moved into policies, and then it ends being deployed from that vantage point, and the only thing left to do is to consider whether or not you're going to start running your expenses through it. That's the very last step. So that's like 5 years down the road for almost everybody. The very last step is, when all of your expenses could be paid into infinite banking policies and paid from infinite banking policies. This kind of leads us to another discussion that's very common, which is what the heck did Nelson Nash mean when he said premiums and income should match in his book? It's the same type of vein where, like, he's trying to describe a world in which all of your money flows into policies first, and your income and your premiums are equal. So if you make $100,000 of income, you're paying $100,000 a year of premiums and living off policy loans, let's say, or it's caused a ton of confusion in the infinite banking community as to what Nelson Nash meant. And it's one of the probably the most asked questions that Nelson Nash received especially from agents. We're like, hey, we want to know what you meant by this, because do you actually mean that someone who makes $100,000 should actually have their premium, pay $100,000 worth of premiums every year and borrow, and maybe their expenses are $70,000, and so they're going to borrow $70,000 from the policy, and then if they do it that way, Are they never going to repay the loan? Or are they going to wait for a windfall? I mean, what's the idea here, Nelson? And I asked him this one time at a meeting where he spoke at, and a lot of other agents have asked him this, and the main thing he wanted to say was he's trying to expand our minds to begin with. He's trying to help us see the idea for the way it truly is. It's a psychological thing. Where psychologically you have to, in order to get into IBC and do it well, you have to truly believe that your policy is your bank and it's replacing the banking system that you could get elsewhere. So he's mainly using it as a psychological thing. Just think for a moment. Think that if you really believe that this is not you buying a life insurance policy, but this is you opening a banking enterprise, then you really do want as much of your money as you can possibly muster to flow into your banking enterprise, not somebody else's, and deploy money from your banking system, not from Wells Fargo or Bank of America or something like that. So that's what he's trying to do, first off. But second off, he's like 5 steps ahead of everybody. he's so far ahead of everybody. And so I remember he mentioned this to me. He's like, well, so I asked, how do you do this premium equals income thing? Like do you just borrow money to live on and you have all your money going into premiums? I mean, how exactly does this work? And he even mentioned to me the idea of, well, premiums are premiums. It doesn't matter how they get paid. And I was like, oh. He's like, in other words, you could have, if you made $100,000, you could have $100,000 of premiums, and you could just have a lot of the premiums being paid from policy cash values themselves already. And I was like, oh yeah. In other words, he was saying use what's called premium offset. So he's like, you could capitalize a policy for 5-6 years and really just max fund those things. And then the policy could pay for itself for forever. And then you could you could take your cash flow and start another one. And you could take your cash flow and start another one. What he's trying to say is it's not unlikely that you could create a world in which case the total amounts of premiums that are being paid into your banking system are actually your income. You don't necessarily need all of it to come out of your pocket per se. You could just have the policies that are sufficiently funded pay for themselves, opening up opportunity to pay more premium to expand the system to where the total premium that's being paid in your life and your income actually match. And all I'm trying to say is Nelson didn't put these things in boxes that we put. He was extremely imaginative. So it wasn't like he was trying to pitch the world that they should have all of their, $100,000 of premiums paid out of pocket, and that's all your income, and $70,000 borrowed out to pay for your expenses, and just ride an ever-increasing loan balance in the future, coupled with an ever-increasing cash value. And that wasn't what he was exactly trying to say, though it could be done that way. What he was actually just bringing up is that you should be so focused on capitalizing policies that you get to the point where the total premiums that you are paying are equal to your income. It doesn't matter if premiums are coming from cash flow and your ability to save money. It doesn't matter if premiums are going to be paid this year from investment returns or sales of investments. It doesn't matter if the premiums are going to be paid from premium offset, from capitalized policies just paying for themselves. It doesn't matter. But the goal, the psychological thing he was trying to get us to commit to, was to say that you should think big. You should psychologically don't see premiums as these expenses to avoid, but see them as an exciting capital transfer, and that you are excited to move money in and to avoid the fear of premium at all costs. Now, don't be crazy. He also said it takes 15 to 20 years to get there, by the way. So I think that's because he was capitalizing policies, and then he would have the policies fund themselves, and he would capitalize another one, have it pay for itself, and capitalize another one, which I'm not even trying to recommend per se in this show. I'm just saying I think that's what Nelson Nash did. Is he wasn't afraid. A premium payment is a premium. It doesn't matter if it comes from your $1 million of cash value that you have built up, or from your bank account, or from your cash flow, or from investment cash flow, or from a sale of investment. He's just saying you want to have in your life as much money as you possibly can go into premiums before it's deployed. And I don't think he was really trying to say everyone should just pay, if you make $100,000, you should pay $100,000 of premium, and then borrow money to live on and just have an ever-increasing loan balance. I don't think that was his angle, though I think sometimes in the IBC community they may take it like that. But all he was trying to do was get us to expand our thinking and to think big when you start banks. To not think of it like a savings account, to not think of it like a trick, or a strategy per se, but to think of it as truly a banking system that you run your life through. So to sum up this episode, can all my expenses be paid through my infinite banking policies? I would say the very last thing you should consider doing is having your monthly expenses paid for from policies. Your first and primary, don't even talk to me about it, by the way. Don't even bring it up until all of your financial operation is intact correctly. So that means that all of your capital is moving into policy premiums first. And the only thing left inside of the bank account is your monthly expenses being paid. As we've talked about, you should really only have 1 to 2 months of operating capital inside of a checking account at any given moment in time. So if you have, $15,000 a month of living expenses, then you should have about 15 to 30K of cash, and all of your income above that 15K of monthly lifestyle expenses should be going to policy premiums first. You should be solidified in that. You should go back to the episode, I can't remember which one it was, where we described how to set this up with your expense account, your capital account, and your transfer account. Maybe we can put a link to that in the show notes for that episode. Once that is solidified and you're rocking and rolling in a perfectly established IBC system, then we could consider whether or not we want to start having all of our expenses be paid through the policies. You would normally do that by the easiest way to do that is to use the life insurance line of credit that banks can offer, and there's quite a few that offer this, and they can offer you a line of credit against the policy that you can essentially use as a true bank account. I mean, there's online banking, routing number, account number, bill pay style systems all incorporated in that life insurance line of credit. So you can do that, but don't go sitting here thinking that Nate's saying everyone should open a life insurance line of credits and start running all of their expenses through policies just because you can. You need to get it built. I'm worried that if I say that, people are just going to start running in and saying that's the answer, even though their premiums they're making like $500,000 a year of income and they've got $50,000 a year of premiums or something like that, and they're just going to try to churn money in and out. There's no magic there. There might be a little bit of extra money to be made by doing it that way, but it's not significant. The significant money is made by transferring all your capital out of the banking system into policies first before it's deployed. Get to that point first, and then we might consider all expenses going through the infinite banking policies. Not really a practical way to do it directly from the insurance companies, but with the banks offering these lines of credit, you can make it a bit more practical. And expand your thinking when you read Nelson Nash's book, Becoming Your Own Banker. Expand your thinking when he says premiums and income should match. All he's saying is that you should commit to funding policies at as high of a level as you possibly can. It doesn't matter if the money comes from the policies themselves through a premium offset, whether their policies are paying for themselves, or whether you've got investment cash flow or earnings or whatever it is. Just expand your thinking. There is a possible way for premiums and income to match. It just, according to his answer to me, what he meant by that was that not all the premiums that you're paying have to be paid from your income per se. You can still pay your expenses from your income if you want, but the premiums could be being paid from the policy cash value, which is your capital warehouse. So I hope this has been helpful. I hope this is maybe shine some light. Maybe I just muddied everything, but I hope it's been helpful to you. It's been fun to talk about at least. And we will see you all next week on Dollars and Nonsense. Remember, if you follow the herd, you will be slaughtered.
Listener, one last thing before you go. Start your journey towards financial security and wealth today. Visit livingwealth.com/escape the bank. Upon completing this course, you'll have all the information that you'll need to see if infinite banking is right for you. Again, go to livingwealth.com/escape the bank.